Look closely at the geography of the Caribbean region. These isolated landmasses sit directly in the path of extreme Atlantic weather systems, completely exposed to the physical and economic devastation of a direct hit. This geographic reality creates what economists call a macroeconomic trilemma for small island developing states, or SIDS. SIDS are nations defined by severe structural vulnerabilities and a high degree of exposure to external disruptions. Governments here are forced into a constant, precarious balancing act between servicing historical sovereign debt, funding basic state capacity, and surviving exogenous shocks like severe climate-induced disasters. Traditional fiscal models imported from the global north often assume stable baseline conditions. Those models break down in an environment where a single natural disaster can erase double-digit percentages of a nation's GDP overnight. For Caribbean nations, the mechanisms of taxation and public expenditure function as the primary engines of sovereign survival. To see how this operates in practice, we will examine three distinct fiscal models currently deployed across the region. First, Jamaica operates a model characterized by extreme historical debt consolidation, heavy austerity measures, and a reliance on indirect consumption taxes. Second, the Republic of Trinidad and Tobago operates as a rentier state. Its fiscal policy relies on hydrocarbon revenues to aggressively subsidize domestic consumer costs. Finally, Barbados provides a model of aggressive sovereign debt restructuring under the International Monetary Fund, or IMF. The IMF is a major UN financial agency that provides loans and structural policy conditions to nations in economic distress. Barbados pairs this restructuring with the integration of climate finance directly into its domestic tax system. Tracing the exact path of a dollar through these three systems reveals the true structural inefficiencies and the hidden macroeconomic vulnerabilities of their broader economies. Over the last decade, Jamaica has executed a widely recognized macroeconomic stabilization program. Through strict adherence to fiscal rules, the state reduced its debt-to-GDP ratio from an unsustainable 147% down to 68.7%. This stabilization required a massive mobilization of domestic capital. For the 2025-2026 fiscal year, the Jamaican government tabled a national expenditure budget of 1.26 trillion Jamaican dollars. Look closely at how that $1.26 trillion is distributed. 95% of the entire budget is immediately absorbed by day-to-day recurrent costs. This includes facility maintenance, operational procurement, and roughly $496 billion dedicated strictly to compensating public sector employees to prevent severe brain drain. The remaining recurrent capital exposes a structural phenomenon known as capital crowding out. Over 27% of total government expenditure is legally ring-fenced purely to pay the interest and principal amortization on the nation's historical sovereign debt. Because debt servicing and public wages consume almost all available liquidity, the Ministry of Economic Growth and Job Creation receives just 5.25% of the total budget for physical capital expenditure. Starving capital expenditure at a 5% baseline severely restricts the state's ability to build heavy infrastructure, creating long-term physical bottlenecks that limit domestic economic velocity. To meet these massive debt obligations and prevent institutional collapse, the Jamaican Treasury is forced into aggressive revenue extraction from its domestic labor market. The state captures this revenue through a complex matrix of statutory social contributions layered over the formal labor force. This creates a heavy effective tax wedge. When a business generates a formal employment contract, it must instantly cover a 12.5% payroll burden. This includes matches for the National Insurance Scheme, the National Housing Trust, the Education Tax, and the Heart Trust Levy. The Heart Trust is a mandatory employer-only tax that funds national vocational training initiatives. Simultaneously, the employee loses an equivalent percentage to those social schemes, followed by a 25% pay-as-you-earn, or PAY, income tax on any earnings above the statutory threshold. PAY is the standard system used to deduct income tax directly from a worker's formal paycheck. A combined tax friction of this magnitude heavily incentivizes both the business owner and the worker to abandon the formal system entirely and structure compensation off the books in the shadow economy. As informality expands, the multi-trillion-dollar cost of funding the state falls disproportionately on a shrinking captive base of corporate professionals and civil servants who cannot hide their income. The government's primary defensive maneuver against this attrition is to continuously raise the personal tax-free threshold, currently projected to reach 1.9 million Jamaican dollars. This surgically removes tens of thousands of low-wage earners from the direct income tax roll, reducing their incentive to seek informal employment. To recapture that lost revenue, the state shifts the tax burden from the worker's paycheck directly to the cash register. They utilize a broad 15% general consumption tax, or GCT. GCT functions as a traditional value-added tax applied to the domestic sale of most retail goods and services. By taxing consumption rather than income, the state forces the informal economy to contribute to sovereign debt payments every time they purchase consumer goods. Navigating this heavy tax burden requires political leverage. Citizens are generally more willing to accept high payroll deductions if they believe the funds are strictly earmarked for highly visible, popular social programs. Jamaica's education tax is a prime example of this psychological mechanism in public finance. The nomenclature suggests an actuarial trust ring-fenced exclusively for building schools or increasing teacher salaries. However, the legislative reality operates quite differently. The specific dollars collected through the education tax bypass isolated educational trusts. Instead, they are swept straight into the Consolidated Fund. The Consolidated Fund is the central treasury repository where almost all government revenues are pooled together. Once inside the central pool, the revenue completely loses its programmatic identity. It is subject entirely to the discretionary allocation powers of the Ministry of Finance to pay for general state operations. Without strict actuarial auditing, the illusion of ring-fencing allows the state to utilize nominally targeted social contributions as stealth general income taxes. We see a stark contrast when looking at the Republic of Trinidad and Tobago. Here, fiscal policy is entirely dictated by the volatile movements of global energy markets. Trinidad and Tobago's national budget is explicitly pegged to commodity price assumptions, currently calculating expected revenues against a baseline of $73.25 per barrel of oil. The extraction of immense hydrocarbon rents affords the state the luxury of a highly lenient stance on individual taxation. Citizens receive a massive personal tax-free allowance of 72,000 TT dollars, paired with a low domestic VAT of just 12.5%. Instead of deploying overlapping percentage-based payroll deductions, Trinidad and Tobago utilizes a highly streamlined approach. Their health surcharge is capped at a nominal rate of just $8.25 per week. The state directs its $59.23 billion expenditure budget heavily toward domestic subsidization. Immense capital is deployed to artificially suppress the market costs of water and electricity, while establishing multi-million-dollar funds to sustain short-term public employment programs. However, this rentian model contains a severe structural vulnerability. When domestic energy production declines and global prices fluctuate, the state is immediately forced into consecutive multi-billion-dollar fiscal deficits. To cover the shortfall between low tax revenues and high subsidy costs, the government relies heavily on domestic borrowing and continuous drawdowns from its Heritage and Stabilization Fund, or HSF. The HSF is the nation's primary sovereign wealth fund designed to buffer the economy during periods of low petroleum revenue. Drawing upon finite sovereign wealth to fund basic, day-to-day recurrent expenditures artificially delays the difficult, mathematical necessity of building a sustainable non-oil tax base. Further east, Barbados operates a highly constrained, tourism-dependent services economy, entirely devoid of the buffer provided by commodity wealth. Following a severe sovereign debt default in 2018, the Barbadian tax architecture was systematically dismantled and restructured under the IMF-supported BERT program. BERT stands for the Barbados Economic Recovery and Transformation Plan. This restructuring created a tight balancing act. To attract foreign capital, the state slashed its corporate income tax to a maximum of 5.5%. To compensate for this missing revenue, the government levies a punishing standard VAT of 17.5%, escalating to 22% for telecommunications. Even with strict macroeconomic compliance, a single Category 5 hurricane can wipe out the island's entire fiscal progress overnight. Acknowledging this reality, the 2025-2026 Barbadian budget introduced the Resilience and Regeneration Fund, or RRF. The RRF is a dedicated sovereign liquidity pool designed for disaster mitigation. It functions as a strict 0.25% statutory levy, applied directly to the gross earnings of both employers and employees. This mechanism forces the domestic capitalization of climate risk. Rather than relying entirely on slow, highly conditional post-disaster international aid, the state generates an immediate, unencumbered pool of domestic sovereign liquidity. Furthermore, classifying it as a regeneration fund gives the government the legal framework to proactively finance high multiplier mitigation infrastructure, like coastal seawalls, before disaster strikes. Barbados has institutionalized climate adaptation as a core, non-negotiable pillar of its sovereign fiscal architecture. This radar chart maps our 3 case studies. In Jamaica, aggressive debt consolidation necessitates massive tax wedges, inadvertently cannibalizing the formal labor market. In Trinidad, relying on volatile hydrocarbon rents to heavily subsidize consumer lifestyles creates a deficit trap that tightens as energy transitions accelerate. And in Barbados, strict macroeconomic restructuring is paired with the localized institutionalization of climate risk, offering a blueprint for long-term domestic self-reliance. In an era defined by extreme climate volatility and shifting global markets, the survival of a small island developing state relies entirely on the structural efficiency, foresight, and adaptability of its fiscal code.